Right. In 2005, the company behind Topshop paid out £1.2 billion, the largest dividend in British corporate history, and not a penny of UK income tax was paid on it. It wasn't illegal. It wasn't a scheme the revenue could unpick. It worked because of one fact most people never think about. The company was British. The owner wasn't. Somewhere in the Treasury, a man with a calculator looked at the largest dividend in British history, checked the rules twice, and wrote down 0, then presumably went for a long lunch. Now, before you reach for a notepad, I'm going to tell you up front, this was 2005. The rules that let it work so cleanly have been tightened twice over, and I'll show you exactly where. But the principle underneath, it's one of the most important things a UK business owner can understand, because it's the difference between a structure that's real and one that collapses the moment someone looks. Quick one, while you're here, yes or no in the comments. Would you have taken it? 1.2 billion, no income tax bill, all legal, yes or no? Be honest, stay with me, subscribe. This channel explains what the wealthy actually do legally every week. Like before you go, helps it reach the people it's for. And before we get into it, if you own a UK company and you'd rather have professionals across this, that's exactly what we do. The structuring at CT Private Office, the accounts and the compliance at Tax for Pros. One link on screen and below, one short application, and we'll point you at the right door. Here's the setup. Sir Philip Green ran Arcadia, Topshop, Topman, Burton, Dorothy Perkins, the lot. A very British high street empire, earning very British profits, paying very British corporation tax. But Sir Philip wasn't the registered owner. His wife, Tina Green, was. And Tina Green lived and still lives in Monaco. She'd moved there back in 1998. For tax, she was the legal owner of the family's wealth. So in 2005, Arcadia paid a dividend of £1.2 billion. It went to Tina Green, a Monaco resident. And Monaco charges its residents no personal income tax at all. The company was here, the shareholder wasn't. And that one fact is the whole story. So why no UK income tax on £1.2 billion? Two reasons stacked together. One, when a non-UK resident receives a UK dividend, special rules treat that dividend income as, and this is the actual statutory word, disregarded. £1.2 billion, and the UK tax system's official position was to look the other way. Try getting the taxman to disregard a £100 late filing penalty. But £1.2 billion straight through. The UK doesn't deduct tax at source on dividends, so the tax the non-resident owes on it's effectively capped at nothing. 2. Monaco then takes nothing either, because Monaco has no personal income tax. UK, 0. Monaco, 0. The money lands clean. Now here's the bit I won't let slide, because this is exactly where bad content gets people in trouble. That 1.2 billion wasn't magically untaxed. Arcadia was a UK company. It paid UK corporation tax on the profits underneath that dividend, the same as any British company. What the Monaco arrangement removed was the second layer, the income tax on extraction, the bit a UK resident shareholder pays when they take the money out. The BBC's Money programme estimated the family saved around £300 million in UK income tax this way. That's an estimate, not on the revenue figure, so treat it as a ballpark. But notice what it's the saving on the second layer. The corporation tax underneath was paid either way. Quick one, because I read the replies. Yes or no? Is it fair that the profit of a British company can leave the country with no UK income tax on it? Just yes or no. Now the part the breathless internet posts always skip. This isn't a switch you can flip on Monday by gifting your shares to your spouse. First, the settlements rules. If you divert your income to a lower taxed spouse, there's a whole chunk of legislation, Section 624, and around it, built specifically to catch that. It only escapes if the gift of shares is a genuine, outright, no-strings transfer of real ownership. Not just a right to the income, with no quiet arrangement to route the money back to you. Tina Green got past that because it was real. She genuinely lived in Monaco since 1998. She was the genuine owner. Real substance, not a paper move. Second, the whole world around this has tightened. From the 6th of April 2025, the old non-dom system is gone. Both parties raced each other to abolish it, the only genuinely bipartisan enthusiasm the Treasury has produced in years. Domicile no longer decides your UK tax. It's residence now. And for inheritance tax, if you've been UK resident for 10 of the last 20 years, your worldwide estate is in the UK net, with a tail of years after you leave. Third, the 5-year rule. Go non-resident, strip a big distribution out, and come back inside 5 tax years, and the taxman can tax it on your return. And the carve-out that used to soften that rule, dividends paid from profits the company earned after you'd left, was abolished this April. Leave, empty the company, come home used to half work. Now it fails in full. The move has to be real, and it has to last. In 2005, the door was open and unattended. Today it's open, logged, and fitted with a 10-year memory. So in 2005, on those facts, with a genuinely Monaco resident owner, it was lawful and it worked. Today, with a UK resident spouse and a token move, it falls apart. The difference every time is whether it's real. So you're not Sir Philip Green. What's the actual lesson for a UK company director? It's this: who owns your shares and where they genuinely live decides the tax on extraction, not a clever scheme in one tax year. Ownership and residence done with real substance. For most owners, the lever isn't an offshore spouse. It's the structuring you do while you're here, how much profit you retain versus extract, whether a holding company makes genuine commercial sense, your salary and dividend mix, pensions. And yes, shares can sit with a spouse, but only as a genuine gift the law respects, not income. Shifting the revenue will unwind the limit, plainly. Every layer of this has a gate on it now. The settlements rules, the residence regime, the 5-year rule. Build something real and it stands. Build something clever and thin and it doesn't. So the takeaway, Tina Green didn't dodge a tax. She was genuinely Monaco resident and genuinely the owner, and that's the whole difference. The same rules are written down for you. The only question is whether your structure is real enough to stand on. That's what we do. 2 doors behind 1 link. CT Private Office builds the structures, the kind that still hold up when someone checks. Tax for Pros keeps the company clean underneath. The accounts, the VAT, the filings, whichever you need, apply at the link on screen and below. We don't take everyone, but if this made sense, you're probably who should apply. Like this if it cleared up how the green dividend actually worked. Subscribe. There's a famous name and a real tax lesson every week. And tell me, yes or no, is it fair that a British company's profit can leave tax-free? Thanks for watching. Every like, every comment, every subscribe keeps these coming, and it costs you nothing.